Good afternoon, members. It's my pleasure to be with you all today. And I thank Madam Sri Priya, Mr. Vardarajan, Mr. Ramu, and Sendil Kumar for this wonderful opportunity. And thanks, Sendil, for giving a very detailed account of my CV. I just sent my raw CV. I did not want you to take so much time. Just a small word of reconciliation between the 4 decades and the 23 years which he mentioned. 23 years as a partner and 40 years of professional experience. Right? So it's a great pleasure for me. And another one more highlight is I only work on audit matters for the Institute of Chartered Accountants. I don't do anything outside of that. I don't write books outside. I do the work for the institute, for the profession on an honorary basis, and that's it. And I used to work for Deloitte because my mentor and guide gave me one advice. The profession did not take anything from you to make you a professional. So when you give back to the profession, make sure you don't take anything from it. So I followed that principle. And another principle is he always told me, no matter who wants to know anything technically, don't make a distinction between who it is. So therefore, whether it's a conference, All India conference, or whether it's a state conference, whether it's a regional conference or it's a CPE seminar, the moment somebody requests and I'm free, I'm available because every member is an equal member, and that's what our institute follows as a principle. So it's great to be with you all today on a topic of current interest. The way Ishwaramurthy addressed his speech, wherein his concentration was all on Schedule 3, I can make out the current feeling in the corporate world on Schedule 3 and the buzz around it. And normally when amendments come in, people say, yeah, it's a new amended form. We look at it when the accounts are prepared. Only when they see this kind of an exhaustive form, everybody gets a little tensed because there is so much of disclosure which is required. And from the accountant side, at least for those who I had a good fortune of speaking to them, I told them, prepare a trial balance sheet for the figures in February because there is so much of disclosure which is required. So Ishwaramurthy had set the tone on the why of all the amendments and the thinking of the legislature. So that gives me a good overtone to start my session on amendments to Schedule 3 of the Companies Act. Just confirm to me whether my screen is seen and my voice is clear. Yeah, thank you.
Yes, madam.
Thank you. So, as Ishwar said, transparency is for those who carry out the public duties and exercise public power. Privacy is for anyone else. If we look at the way auditing profession is changing its messaging to public, due to the various happenings on loss of confidence and loss of stakeholder trust, the messaging from the auditors has been to restore confidence and trust in the public. Audit of management integrity. It's not only the financial statements anymore. And explaining the value of an audit and taking the real value of the audit to the public. So you will agree with me that the expectation from the stakeholders and the environment has given this kind of, I would say, a different avatar to the role of auditors. Gone are those days from watchdog to bloodhound and all the stories which were there. Today, the auditor is expected to be responsible for whatever happens. When we look at our presentation today, I'd like to go through the changes in the disclosures by way of additional information to stakeholders, the format changes, and touch upon the main auditor's report, not the CARO. So, the rationale for this enhanced reporting. The expectation of corporate regulators has been made visible by way of amendments if you look at history. When Enron came in and the impact of the off-balance sheet items not necessarily reported completely was felt on the market, there was a lot of importance and increase in disclosures and consideration of off-balance sheet items. and looking at them with a closer eye. When WorldCom came in, the internal transfers and the false operating expenses, more responsibility was put on branch auditors and the kind of overall responsibility for the main auditors. And there came in our auditing standards on group audits and the kind of responsibilities. Only in India we have that paragraph to say that the the other subsidiaries were audited by other auditors. It is nowhere in the world the main auditor takes responsibility, because all the audit reports of the subsidiaries are given to the main auditor, and he has got the right to inspect the books or inspect the auditor's files whenever he or she requires more information. So after WorldCom, when ZBest came in, the auditors focus on risks, on realizability, on frauds, where ZBest had cheated the auditors by making false photocopies on debtors and diverting their attention to other services. Came the question of increasing the auditing requirements, making confirmations, direct confirmations, and all other procedures mandatory. So on things went. And then, based on some of the very recent instances which we have seen in our own country, corporate regulators have an expectation to get more information from the financial statements, more to facilitate their role of inspecting the financial statements. It is no pleasure for them to ask us to give information, all piles and piles of information on an unnecessary basis. When they are looking for a particular aspect, they have found repeatedly that the financial statements or the auditor's report are deficient because the regulation doesn't ask them to report on that. It is nobody's fault. So it was taken as an exercise to make sure that the regulation becomes more comprehensive, to facilitate a review either by a prospective investor or by a corporate regulator for arriving at the satisfaction that the financials are true and fair. The jury is always out with our media, and long spells of analysis go on thanks to the delayed judicial procedures. So there is a need to try and satisfy this activism, which creates a lot of ripples in the market. And therefore, legislation had to answer and had to give a response. And that was by way of various amendments from time to time. Whenever you see a new provision, you will be able to connect immediately on the why of it, because something would have happened which has triggered the government or the department to introduce that particular item. And as Ishwaramurthy said, it is not something which is done overnight. There is a lot of thought which goes in, a lot of discussions among committees, a lot of stakeholders are asked to give their thoughts, and only then a circular or an amendment is released. It need not be that all the amendments should come out for public comments. When there are major amendments, they come out as a set of proposed amendments, and it comes to all the professional bodies. It comes to the chambers, it comes to the institute, and all the institutes give their views. There are various meetings held with the ministry before something takes the shape of a law, a schedule, a circular. The need for ready financial information from financial statements. All of us know that the judicial procedure takes a long time, the investigative procedure takes a long time. How many of us know that ready information is not available for them to proceed with their work in trying to analyze the financial statements? For instance, if you take the audit trail, why are they asking for that? It is not for putting people to test. It's just that, excuse me, can people be on mute, please? Yeah, thank you. And it is not for the pleasure of asking people to collate all the information. When they look for something that is not available, the audit trail, for instance, was introduced because they wanted to have one set of financial statements from the company's books and from the auditor's files. They did not want various versions floating around. And when they asked for the books for investigation, the books which are received have got adjustments for which no link is available, because probably some of the adjustments were made, genuine adjustments were made in Excel sheets, and they were probably preserved somewhere else in the server. So we don't have necessarily a proper habit of making sure that we collate all the aspects in a financial statement set. If it's a large company, the volume itself is an issue. The period 13 adjustments which come in into the automated systems are an issue. Similarly, if they are smaller companies, these Excel adjustments are missed out somewhere. The recent spike in reported frauds, the various frauds which have been reported have instigated regulators to put in more disclosures. And the accountability and responsibility of the auditor have significantly increased because the CARO reporting had made the changes 2 years ago. And it was only genuine that the chartered accountants expected the companies to have the primary responsibility to make these changes. And therefore, Schedule 3 followed suit, thanks to the fact that CARO was delayed by 2 years. The amendments to Schedule 3. It is under the Companies Act 2013. It was on 24/3/2021. Additional disclosures had to be given for the period from 1/4/21. Companies Accounts Rule 2014 and the Companies Audit and Auditors Rules also brought about changes. The changes were having 3 sets of balance sheets: Division 1 for the IGAP companies, Division 2 for the Ind AS companies, and Division 3 for NBFCs. It is not based on the size of the company. It is the disclosure required based on the type of accounting and balance sheet to be presented by the 3 different scenarios. Of course, part 1 had the form of the balance sheet and the SOEC, where SOEC was there, and SOCE, sorry, was there. And part 2 is the P&L and the general instructions for preparing the P&L. And part 3 is the general instruction for consolidated financial statements. So 3 parts in each under Division 1, Division 2, and Division 3. The presentation generally followed a current and a non-current assets and liabilities had to be shown separately. An exception-based reporting in the order of liquidity was allowed if it was more meaningful, or even a hybrid presentation was allowed if it made more meaning to convey the financial statements in a proper manner, or if a company has diverse operations, this hybrid system was allowed. The compliance in its full form means compliance with the Schedule 3 and the Ind AS 1. So therefore, what is in Ind AS 1 is applicable across the Schedule 3. We may be touching upon some of the disclosures, but this presentation is primarily to understand the amendments in Schedule 3. General instruction is there on materiality. All of us know the definition of materiality, that which influences the decision of the economic users. If the law and the Ind AS differs, the law shall prevail for the accounting treatment purposes. We all know these general principles. When we start with the first aspect on share capital, we know that shares held include stock, which is the interest of a member, measured for liability and for dividend purposes. The shares held by promoters at the end of each year, promoter-wise, class-wise, should be disclosed with the percentage change during the year based on the comparison to the opening balance or the first issue which was made during the year. The promoter under the Companies Act is a person who is named in the prospectus or identified in the annual return under Section 92. or a person who has control over the affairs of the company, directly or indirectly, whether a shareholder, director, or otherwise. So it is important for us to analyze the relationship as a promoter. The percentage changes, of course, in relation to the base, as I mentioned earlier. Statement of changes in equity. This is where it's an Ind AS presentation in division 2 and 3. Equity share capital, the movements have to be given, balance at the beginning, change in equity capital due to prior period errors, restated balance, changes in equity share capital during the year due to fresh issue, and balance at the end of the year. Friends, please note that all these movements have to be given not only for equity share capital, but for the list of items given below. So it's a vast schedule. So for each of these line items in the gray box, it is important to give each of the movements as mentioned in the orange box above. The statement of changes in equity, the changes have to be disaggregated further to give the equity portion of compound financial instruments, effective portion of cash flow hedges, debt instruments through fair value other than OCI, equity instruments, fair value through OCI, and effect of foreign currency translation, and also the impact of prior period errors. So the SOCE is a very exhaustive statement which has to be given in the disclosure. Loans. This is applicable to NBFCs. The items which have to be disclosed separately are in the first box, the blue one. The first one is the line items which have to be disclosed item by item, right from bills purchased up to the others, which includes intercorporate deposits and so on. That has to be broken up into based on whether they are tangible assets, intangible, whether they are under tangible assets, secured by tangible assets or secured by intangible assets, whether they are covered by government guarantee or whether they are unsecured. That has to be disclosed. The next aspect is they have to be measured. In what form are they measured? The loans. Are they at cost if it is a non-Ind AS? If it is Ind AS, are they measured at amortized cost, fair value through OCI, or fair value through profit and loss account, or designated at fair value through the P&L? The impairment allowance has to be calculated according to Ind AS 109 and should be disclosed as a separate line item. Extensive disclosures relating to credit risk on the financial instruments have to be disclosed, and that has to be also given in detail. Trade payables. When we talk about trade payables, it is normally for goods and services and other items which are not contracted or obligations under other payables and not under trade payables. They are normally under other non-financial liabilities. So outstanding trade payables, normally we used to have one figure in the past. Now they'd like to understand the aging of these payables just to ascertain whether the company has got enough liquid funds to pay them. So it is based on less than a year, 1 to 2 years, 2 to 3 years, and more than 3 years. Again, the segregation of MSME and others. The third segregation is dispute and undisputed, again with MSME and with others. If the date of payment is specified, the aging starts from there. Otherwise, it is from the date of the transaction. Unbilled dues are supposed to be disclosed separately. Friends, MSME rules had changed in October 2019, and your sector, you should be dealing with them every day. But just for a recap purpose, a micro entity is an investment of 1 crore and turnover of 5 crores. A small entity is investment of 10 crores and turnover of 50 crores. And a medium entity is 50 crores to 250 crores. Property, plant and equipment. When we talk about property, plant and equipment, it is the normal list of property, plant and equipment which you and me are used to from the time of Schedule 6, and it also includes biological assets. That is something which is one of the recent, I would say, last 5 years having importance. That's why I mentioned that. A reconciliation of the assets gross and net value at the beginning, then and the end, showing additions, disposals. It is not adjustments. It has now been substituted with the word disposals. Acquisitions through business combinations have to be mentioned separately. If there is a change due to revaluation, and if the change is more than 10%, it has to be disclosed for each of the items, and all other adjustments relating to depreciations, impairment losses, and reversals have to be disclosed separately. Because what used to happen is we used to have additions and adjustments, and everything would be an amalgam under adjustments. And it is important to break them down and disclose for transparency purposes, so that if there is an impairment loss, which is material there, we like to understand as an investor why that loss has happened. Is it provided at the right time, or was it supposed to be done in the past, and so on. Talking about all these guidances on PPE, it is no longer called tangible assets, it is PPE. And all these guidances apply to investment property as well, if they are held for sale. The additional regulatory information on immovable property. When the balance sheet showed property, plant and equipment, immovable property of a huge value, investors would believe that these are all realizable, maybe long drawn litigation, but these are assets in its true value. Okay, if the assets were not, title deeds were not transferred, we used to have a habit of good disclosure to put an asterisk and say title deeds pending transfer. Okay. That used to be a simple disclosure. Whoever had the presence of mind to do it, did it. But now it is legislated that wherever title deeds are not held in the name of the company, what are those kind of title deeds other than lease transactions? Which is the property? What is the gross carrying value? Whose name is it held now? Is that deed holder a promoter, director, or relative? So much of detail has to be disclosed, and the reason why it has not been transferred. So, also the ownership of the immovable property joined with somebody else. If so, what is the extent of share? All this is required to be disclosed for property, plant and equipment, investment property, property, plant and equipment retired from active use and held for disposal, other non-current assets held for sale, and any other items under PPE. So then, if there is a revaluation of the PPE property, there is a requirement to disclose the basis of the valuation and who has done the valuation under the Companies Act. For capital work in progress, again, an aging requires to be given. The whole rationale behind all these disclosures and amendments is for us to understand the realizability of the assets and the stretch by the company on settling its liabilities. So if we keep that in mind, then we will understand why these disclosures come in for practically all asset items. So, and the aging pattern is the same. Less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. For CWIP, projects in progress, projects temporarily suspended, these have to be disclosed clearly according to the aging schedule. Where the capital work in progress has a due date for completion and that is overdue and it is extended. 1, in terms of the deadline. 2, in terms of the cost when compared to its original date and plan, that has to be disclosed separately. Again with the aging, giving project wise where the activity has been suspended has to be given clearly. This makes it very clear for anybody to understand where the funds are locked up, why the project has a problem, and if so, why an impairment has not been taken on the project. Because due to technical happenings and technical matters not being completed, projects could be long drawn, interest burden on the loans could get added, it could get capitalized, And the project finally, even if it starts operating, could become unviable or not necessarily as profitable as planned. To get a feel of this, in the years when this is mounting, is the idea to have this disclosure in the balance sheet, so that it is very easy for the investors to be on guard or the lenders to be on guard to start scrutinizing and following up on these projects. We spoke about revaluation. In revaluation, a registered valuer under the Companies Act is the person who is authorized. You are all aware of the registered valuer and the valuation rules 2017 and the kind of training given by our CA Institute on that. The fair valuation of investment property is definitely to be based on the valuation by a registered valuer. If there is more than 10% increase in the revaluation, it has to get reported item wise. And if it's an external valuer, you try and test the competence as an auditor of that valuer, whether he's a qualified person, what is his experience, and so on. If it is done by an internal valuer, then the question is, how is the fair value determined? Is it in accordance with Ind AS 113? And this, of course, you should remember, doesn't include the case of a business combination. The valuation done internally or externally is critical for us to consider the level of disclosure. Benami property, something which attracts the attention of everybody by the very term. A Benami property is a property subject, which is the subject matter of Benami transaction. It includes the proceeds from the property. According to Section 2.8 of the Benami Transactions Act and 2.9, it's a transaction or an arrangement of a property transferred or held by another person. A property held for immediate or future benefit, direct or indirect, a transaction which is in a fictitious name. A transaction where somebody denies or they say they are not aware of the ownership, or a transaction in which the consideration provider is not traceable. So when we talk of details of Benami property held, all these aspects have to get covered. Because it's not necessarily defined in this schedule, we have to go back to that act. In short, any transaction which allows the possession of property but does not fall under Section 53A of Transfer of Property Act is covered under this Benami definition. So, a Benamidar, of course, you know, is in whose name the property is transferred. So, details of Benami property held, whether any proceedings have been initiated under the Benami Property Act. That is fairly easy to disclose because we can find out, get representations from the legal counsel independently, and the company can also get this representation, and therefore, if there are proceedings, the proceedings will very clearly state which property, what it is, whether it's in the books, not in the books, can be traced. Details of Benami property held is where the challenge comes. Checking of those whether Benami properties are held or not. Under all those kinds where the definition states, is something I think we'll have to do a research and find out how to put in the audit procedures to make sure that the whole thing is complete. Whether there are any proceedings against the company under the company law, as an abettor or as a transferor in a transaction. Those details have to be provided. For now, what is happening is details of Benami property, none. And whether there are any proceedings which have been initiated, again, none. And there are representations and all kinds of supports collected for these. At least I have come across only those kind of disclosures. If there are Benami transactions which are on which proceedings have happened, it is straight to pick up from those proceedings and disclose. But that alerts an investor on his future investment in the property. Intangible assets. 3 items: goodwill, other intangible assets, and then the other assets which are contract assets, capital advances, security deposits, and prepaid. For all these, a reconciliation is needed at the beginning and at the end of the reporting period, showing additions, disposal. Same thing like your fixed assets, acquisitions through combinations, revaluation, other adjustments, losses, reversals. It follows the same theme. Intangible assets also are under the same theme. Intangible assets and CWIP are considered in the same manner: projects in progress, projects temporarily suspended, intangibles, aging. Where activity is suspended, it has to be shown separately. So a completion schedule for intangible assets under development is definitely required. Companies may not have even thought about preparing a completion plan and a schedule. There could have been infructuous assets under scientific research which have not been written off. This is the time to look at them closely and clean up this account balance. The collation of assets for intangible assets under development is a challenge, especially to take the internal costs and to capture costs such as employee costs is easy, but about other costs, unless there have been codes from the beginning to capture this separately, it would be very difficult today to give a true account of those. Trade receivables, just like trade payables, the aging pattern is the same. Particulars outstanding from the due date, 6 months, less than 6 months, yes, according to the old disclosure, 6 months to 1 year, and then it goes on and more than 3 years on. When it comes to trade receivables, it is important to note that trade receivables considered good under dispute. Okay, these are two main classifications. Then under them, trade receivables which are considered doubtful, both disputed and undisputed. So considered good, considered doubtful, under disputed and undisputed. These have to be given. In addition, those receivables which are credit impaired, again under these earlier classifications, or receivables which have a significant increase in credit risk. So all these classifications have to be considered, and the trade receivables schedule will look like a matrix presentation. And information on when it is due, how do we calculate? If the due date is mentioned, from the due date, if not, from the date of the transactions. And remember, any unbilled dues have to be disclosed separately. When we talk about loans given, the disclosure is required for the line items: bills purchased, discounted, loans repayable on demand, factoring, leasing, other intra-corporate deposits. As said earlier, the cost. Is it at amortized cost, fair value through P&L, designated fair value through P&L? The next aspect is security. How are they secured? As we saw in the earlier case. Security by fixed assets, intangibles covered by guarantee, unsecured, secured by book debts and fixed deposits. Location of the loans. Are these loans in India or outside India? Finance leases. As finance leases, they have to cover all the provisions of AS 116 and Schedule 3. And the credit risk on financial instruments, we have to make sure that we meet the disclosures of AS 107 and that of Schedule 3. Other financial assets, security deposits, bank deposits which have more than 12 months maturity, and other items are to be specified. When we talk about other non-financial assets, inventory, current assets, investment property, biological assets other than bearer plants, financial liabilities, debt securities, bonds and debentures, and liabilities arising out of securitization. There again, the classification, just as in the past, secured, unsecured, liability aspects, how are they valued, and whether they are within India, outside India. For bonds and debentures, what's the rate of interest? What is the order of maturity and conversion? What are the particulars regarding redemption? When we look at borrowings, the various aspects, term loans, deferred payments, loans from related parties, the whole host of things which are there in those blue boxes. The terms and other liabilities for each of these, the nature of security, the terms of repayment. If there is any default, it should be listed based on the category of borrowing, and it has to be disclosed. Any finance lease obligation, and then measurement, again, whether they are at amortized cost, fair value through P&L, designated fair value, and whether they are in India, outside India, and whether there are deferred payment liabilities. When there are borrowings from banks or financial institutions on the basis of securities, it is important that we have to disclose, the company has to disclose that quarterly returns and statements for current assets which have been filed with the bankers are in agreement with the books of account. And a summary of reconciliation and reasons for material discrepancies have to be given. Mind you, this is a requirement through the year. It is not as at balance sheet date. The quarterly returns or statement of current assets. So if it was not filed quarterly, whenever it was filed, based on the loan agreement. So they have to match quarter on quarter with the books of account. The first thing is there should be a discipline to close the books properly and to match the quarterly returns. This is an area which is difficult for mid-sized companies and companies which do not have a monthly closing process. And therefore, the auditor's duty is to alert these companies at the beginning of the year to make sure that they meet this requirement before they file the returns with bankers, because mistakes can happen in numerous ways here. So if they don't match, then it is important to give a reconciliation. The current maturity of long-term borrowings has to be disclosed separately. That's one more requirement under the borrowings, which I forgot to mention in the previous slide. When we look at this requirement, it is for working capital facility sanction above 5 crores. So let's take a case where the sanction is 10 crores, but we utilized only 4 crores. That doesn't matter. It is the sanctioned amount where this requirement is applicable. That has to be remembered. So when we have to report on this, we have to check all those items based on the sanctioned amounts, whether you are utilized or not. And where fixed assets are pledged, book value and actual value has to be checked. Loans and advances in the nature of loans granted to promoters, directors, KMPs, and related parties. This disclosure is required whether it's repayable on demand and whether there are amounts given without specifying any period or repayment. And if there's any borrowing, the details on that borrowing which are in the slide have to be disclosed. It is to be given in a tabular form for each category. On the second bullet, on the type of borrower, amount of loan, each of these have to come in a table form for each category of director, KMP related party. It's not an amalgam amount which is to be disclosed. These don't include those in the ordinary course of business under NBFC, but the disclosure under related party makes it mandatory to disclose everything. Other financial liabilities. This is the whole list of items which require disclosure. When we used to learn as article clerks the Schedule 6, half these items never existed. So mugging up the Schedule 6 was very easy. Today, even to repeat what's in the slide is so strenuous. Other non-financial liabilities. That's the list of current tax, provisions, deferred tax, other non-financial liabilities, contract liabilities, and liabilities for assets held for sale. Investments. The first orange tab talks about the kind of investments. The gray tab talks about the method of measurement, the cost, fair value, and so on. If the NBFC has used another basis, which is in the yellow box, that has to be disclosed. The last one is talking about a loss allowance for any expected credit losses on investments which are measured at amortized cost. Fair value changes in the case of debt investments, and so on. Investments in subsidiaries, associates, and joint ventures. For an entity's consolidated financial statements using the equity method. Where an entity holds investments in subsidiaries, joint ventures of structured entities, what is required? Unconsolidated structured entities, where should it be disclosed? And in the case of an investment other than in a structured entity, what is the nature of instruments and what are the details? What is the face value? Utilization of borrowed funds. where the company has not used the borrowings from the bank for the specific purpose, it has to disclose where these funds have been used. They would like to know the end use of any monies borrowed. When we come to a willful default, a very fashionable term in the recent past for as far as the media goes. A willful defaulter is a person or issuer declared so by a bank or a financial institution or a consortium in accordance with the willful defaulters RBI guidelines. So when you talk about default, it means the default in meeting payment and default in meeting payment and diversion of funds for other purpose. The third is both these items plus the funds are not available for as other assets. All these three are under willful defaults. And if it was defaulted and this was disposed of as payments or any other property was purchased with this, all this comes under defaults. Now, how do you identify willful default? Very clear, if the RBI has declared, we will know it. Bankers now are asked to confirm as part of their direct confirmation that this account is not a willful defaulter. So it is important for us to get that direct confirmation and then look at any of the minutes, any of the whistleblowing, any of the media reports, any of the correspondences with lenders and so on, and get a confirmation for completeness that the company has given all records to us, because we take equal responsibility on this reporting. Companies which are struck off. Again, if there are monies which are in receivables and we believe they are good and recoverable, and unfortunately they are transactions as advances or receivables with struck off companies, then we have a problem on the realizability of those amounts, and therefore transactions with struck off companies have to be given in full detail. So this is under section 243 of the Companies Act 2013 or under 560 of the Companies Act 1958. It is important also for us to understand the relationship with that struck off company after having all these details disclosed. This does not cover those under the NCLT orders. The best way to identify these is to do an ROC search. Doing 100% search is difficult. At least the major transactions between customers and vendors, which are probably outstanding, we could do a search, top 10 items, and find out if there are material amounts, or ask for the KYC certification by the bankers for specific accounts which we would select on a judgmental basis. Registration and satisfaction with charges. Where it is pending beyond the statutory period, those details have to be disclosed. The brief description, location, due date, and reason for delay. Companies beyond specified layers. We know that there are 3 layers under the Companies Act. So where this has not been complied, companies need to disclose those companies and the SIN numbers of those beyond the specific layers, and what is the relationship and extent of holding in those downstream companies. Friends, intelligent stakeholders used to look at investor meeting minutes, investor appraisals. Today, we'd like to make everybody intelligent, and therefore, all these ratios have to be disclosed. No longer the balance sheet, P&L, and cash flow is relevant. This one section which discloses all the ratios is sufficient to tell the whole story of the balance sheet. The current ratio, giving the company's ability to cover short-term obligations. The debt equity ratio, which talks about the financial leverage. The debt service cover ratio on net income divided by debt service. The return on equity, talking about the measure of profitability. The inventory turnover, net sales over average receivables. The trade payables, number of days amounts are unpaid by 365. the net capital turnover, the net profit ratio, which is the measure of profit, the return on capital employed to see how well profits are generated, and the return on investment, the net profit over the average cost of investment. All these very clearly would tell you the health of the financial statements which are enclosed. Of course, the disclosure on capital to risk weighted asset, the CRAR, is as per the RBI guidelines, and we are all aware of the 9% regulation. Please note that the company has to explain the items in the numerator and denominator as to how these ratios are computed. And any change for more than 25% when compared to the previous year, that has to be explained. So when we talk about numerator and denominator, disclosing the ratios, items to be included, sources could be several based on how regulators notify, based on investor reports, industry reports, market research, credit rating agencies. Any of these could be a basis for us to determine how these have to be disclosed and the industry practice. One needs to take care to make sure that we are consistent in the way we compute these ratios year after year. Scheme of amalgamation. Where a scheme of amalgamation is there, disclose that the scheme, all arrangements have been accounted in the books of account in accordance with the scheme accounting standards and there's no deviation. This used to be a certification by the chartered accountant which will get filed with the court before the scheme is approved. Today, this disclosure has been included as part of Schedule 3. Information on utilization of funds borrowed, including borrowed funds, borrowed funds including share premium. When monies have been advanced, loaned or invested, okay, in entities, including foreign entities, directly or indirectly, through intermediaries. It could be funds, it could be guarantee, security. It could be for the benefit of those subsidiaries, intermediaries, or an ultimate beneficiary. So, the moment the funds have been spent, invested, all details regarding that fund movement has to be disclosed. The date it was advanced, further advances, guarantees, and a compliance with FEMA and PMLA have to be disclosed. The idea is that the tracing transactions through various subsidiaries becomes a great hassle when people want to understand the transactions and conduct a scrutiny on one of the company books. And it is important for any investor to know whether the monies have been invested with due business purpose and on entities which have a common objective and common interest. If not, whether proper procedures have been followed and the investment is really producing the expected results to protect the interest of stakeholders. And that is why this detail has to be present. Similarly, when you receive funds, it's the same, the reverse situation. So the same thing, from whom it has been received, whether it has been given to any other intermediary or to an ultimate subsidiary, there again all these requirements. Please note that the term intermediary has not been defined in the Act. So we have to do it on the basis of the objective of these funds which have been given. Inbound and outbound needs to be disclosed. Advances in the ordinary course of business are not covered in this. Please note it is not just pass-through entries in the current year. It is also opening balance, which is there, plus amounts received. Full details on identity, name, address, PAN number, all the details in the relationship, everything is required. And whatever is required from that in the table needs to be disclosed. So, how to audit this? There is a guidance note by the Institute. We worked on it and released it in the month of April. I would request members to please look at that guidance note which has come out on 11E and 11F on the auditor's duty on these two things. Undisclosed income. If undisclosed income has been identified in assessments, that has to be disclosed, whether it was earlier unrecorded and now whether it has been recorded in the books, and if there is an immunity scheme which was there, that scheme also has to be disclosed. Corporate social responsibility. Mr. Ishwaramurthy spoke on the need for CSR and the disclosures. The disclosures have only been strengthened to give all details, including that of related party transaction. And you are all aware that related party definition, as he said, is undergoing changes every now and then. So we need to make sure that all the contributions have been explained clearly with the related party eye focused on those transactions. There are quite a few amendments in CSR on what are eligible spends and not eligible spends. R&D activities related to COVID are those allowed if they are with specified institutes, and expenses for designing and implementation of a CSR program is also allowed as eligible expenditure. There is an overall cap of 5% on admin costs. The unspent CSR funds have to be transferred to an unspent corporate social responsibility account to be spent within 3 years, or else 6 months from 3 years, it has to get transferred to those funds which are under the 7th schedule, which is PM National Relief, PM Care Fund, and so on. Even if something is unallocated, that also has to get transferred in a similar manner. The surplus on CSR funds can be spent on projects, and transfer of unspent amounts, you follow a rule to transfer it to the CSR. If you have spent excess of CSR funds, it can be set off within a period of 3 years. There is an impact assessment requirement. If the average spend is more than 10 crores in the last 3 years, for each project above 1 crore, there should be an impact assessment done by an independent agency as to whether the CSR activity is really useful to the society at large. Cryptocurrency. If there is cryptocurrency or any trading involving profit and loss, those details have to be disclosed, including deposits received for people from cryptocurrency. Talking of some of the basics in the disclosure, it is total income instead of turnover, it is revenue from operations, it is income instead of revenue. And when we talk about borrowings, there are shift in line items and terminologies. And of course, the statement of changes in equity is there. Disclosures which are not applicable to Division 1, mainly because Ind AS is not applicable there. Statement of changes in equity, fair values, amortized costs, and loss allowances. When we come to the board's report, any bankruptcy proceedings which are pending, that has to be reported along with the status. Any difference in valuation of any assets, business, which was done as a one-time settlement, that in comparison to the valuation which was done at the time of taking a loan, if there is a difference, that has to be explained with the reasons thereof. So these two are new requirements in the board's report. In the auditor's report, under other matters to be included, there are 3 requirements: pending litigations, provisions for material foreseeable losses, and any amounts delayed to be transferred to Investor Education and Protection Fund. The auditor's report, those 3 are there already in the report. And the auditor's report now talks about Rule 11E and 11F, which I said that we have a detailed guidance note. Our duty is to state that management has represented that all these aspects are disclosed in the accounts, that in the notes on accounts, and no funds have been advanced other than what has been disclosed. Similarly, where they have received monies, no other receipts are there other than what is disclosed in the accounts. So it is a question of based on management representation and to the best of our knowledge and belief. So what we have done is given enough steps for the auditors to take care on how the representation has to be obtained and what kind of checks the auditors need to do to report on these important clauses. Whether dividend has been declared and paid during the year is in compliance with section 123. This is another specific reporting requirement. So one is the declaration, whether it conforms to the provisions of the final dividend, and any dividends paid, interim dividend paid during the year, that is in accordance with the Companies Act. These two have to be disclosed. Auditors' reports give specifically the details and say that they have verified these details. Okay. The next thing is the audit trail. This has been deferred by a year. Although all software platforms and programs have come out saying that they met the audit trail facility, but the edit log, what is the audit trail scope, whether it is just the basic books of account or is it for all the incoming information through various other operating software. These are aspects which are being deliberated upon. We are working in a study group on this, and we would come out with comprehensive guidance on audit trails from the WASD by the end of the year when the reporting kicks in. Way forward. We need to prepare the comparative information. This session, by the time this session is done today, many companies would have already prepared the details. For those companies which are to prepare balance sheets and complete their work in another 2 months, just an alert that comparative information is required for the previous years as well. We need to assess whether changes required to be made to existing systems and controls. It is not possible to manually compute all these disclosures. The system should generate all this information. Whether we need more support systems to enhance our reporting needs, whether any amendments, whether any sub-programs are required, for instance, in the receivables, the payables, and how well are we going to align with the new reporting requirements. A lot of discipline, user discipline is required. We need our technical departments to support us because a lot of information relating to capital work in progress, relating to intangibles, relating to payables, receivables, is all information which they should provide to make sure that we are able to report truly and fairly the results for each of those figures and the detailed disclosures. IT systems require step up in terms of measures, especially when we talk about the audit logs. The keys to brand success are self-definition, transparency, authenticity, and accountability. Friends, let us make up our minds to be very clear on the self-definition to adhere to Schedule 3. Make sure that the financials reported upon meet those expectations on transparency, are authentic as far as every line item of disclosure goes, and the accountability, which is primarily with the corporate sector and fiduciarily with the auditors, stands to a high test that the investments in India would grow multifold due to the changes in Schedule 3 adopted by us successfully. So that's all from my end. We are at 17:30. I don't think we'd have time for any questions. If there are any questions, we could probably, you could send the questions to me because I know the next session has to start. So, and if there are questions, I'll be able to take it offline.
Thank you, madam, for your valuable information on this topic. I request our secretary to introduce another speaker, Regimal Dubey.
Thank you so much for this wonderful opportunity. Ridhima, I would have loved to stay on, but I have another training on which I have to jump in. So,
no problem,
your session.
No problem. Thank you.
Thank you all.
Thank you.
Very kind
Have
of
a nice
you.
day.
Thank you.